We are glad to have you with us. My name is J.D. Gunter. I am on the investor relationship team here at Multifamily Capital Partners. And this is our director, Mr. Mike Fritz.
Good to meet everyone.
The brains behind the operation. It's true. It's true. We're happy to have Mike on with us today. Today we're talking about tax savings. It's a tax savings masterclass. So by investing with us, by partnering with us, what opportunities does that give you to reduce your tax liability? Why is there such a push for it? Why have we been talking about it so much here at the end of the year? And what's changing here at the end of the year that's really crucial as we have the countdown timer happening right now before the end of the year as investors try to come in. So let me introduce you to our team. This is the executive team. Of course, most of you know Tyler, managing partner, and then Todd. If you've been to multifamily mindset workshops, you've probably either seen Tyler or Todd. And then you have Roman, our chief operating officer. Rowan's fantastic, just released a book recently. Check that out. And then the one and the only director of operations, Mr. Mike Fritz. He comes from a mergers and acquisitions background. He knows his numbers, folks. He knows he is the spreadsheet wizard, and he does a lot of our financial reporting. And so on this technical topic, I'm really very, very happy. There's not anybody I'd rather have on this webinar on this topic than Mike. So Mike, appreciate you being here.
Oh, thank you, man. This
is our investor relations team. So Rada, the lovely Rada, is our investor relations manager. She is handling the chat and the Q&A. She's going to be posting some very helpful information. She'll be answering some of the questions. She's also going to give you our contact information. And so if you'd like to follow up with us, if you'd like one of these fine folks to answer any questions that you have, a lot of times if your question is specific, especially on this topic, if you have a specific question to just your situation, we may not address it in the Q&A or in the chat. We may advise you to follow up with one of our team so that we can better address your specific situation, but we are going to take questions. Please put those questions into the Q&A. If you put them in the chat, sometimes they get lost, so we'll keep an eye on that Q&A, but Rad is going to be running
and
that.
JD, I just want to introduce myself, say hello, and also whoever is in this webinar. If you folks want to hear something that we have not covered, if you follow our webinars on the regular, or if you don't, I welcome you to submit to us. I'm going to be showing you how to do this, our contact information. If there is a topic of interest that you want us to cover, please share that feedback with us. It's very valuable. We do engage in listening to what our viewer is looking for to make sure that we are going to deliver it to you in the future. So thank you, and nice to meet you all.
Yes, well said, and thank you for interjecting. It's lovely to have Rada with us, and she is a seasoned expert when it comes to sales, customer service, customer support. So she takes all of your feedback very, very seriously, and is largely steering the ship behind the scenes when it comes to the webinars, and points us in the direction as far as the feedback of what you as investors want to hear. We want to be providing value to you, as Rada mentioned. So I'm an investor relations specialist. This is Enrique and Karen. They are also investor relations specialists. Our job is to maintain that relationship with you. So whether you've already invested with us or are considering investing with us, we are here to help and would love to talk to you. And so make sure that you follow up, and Rada will provide some details about how best to do that. So we're going to dive into taxes. How do you save money on taxes? How our company can help you through partnering with us on saving money in taxes, the ways that you could save on taxes with real estate in general, and then with us in particular. But we are not accountants, and we do not play them on TV. We have a lot of experience with real estate and taxes. In my background, I was a commercial real estate broker for 15 years. I was in the top 1% in the country for commercial real estate brokers for several years. And then I worked in private equity doing acquisitions, buying apartments, buying hotels and converting them into apartments. As I already mentioned, Mike has mergers and acquisitions background. Rad is very experienced. So we know these details from our personal experience, but a lot of what we're talking about today is specific to your situation. And tax laws are different in every state. They're different depending on how you have your legal entity structured. So please, this is an introductory overview and illustration. We always recommend talking to your accountant about the specifics to see if there's something that you can do with the tools that we're giving you today to put into your toolbox. So that's our disclaimer. With the disclaimer through, here's what we're talking about today. Tax saving strategies, how you can save money on taxes by investing with us. So we're talking about real money. We're not talking just about your gross profit. A lot of times when you look at, for example, our Aloha Fund and you see annual rate of return projected at 16% or 18%, keep in mind that's irrespective of taxes, but that doesn't mean that we ignore taxes. Far from it. Taxes are a high priority for us because it's not just how much money that you make, right? It's also how much money that you keep. And so we want to focus on your bottom line, and we're showing you some things that we're doing for you to help you to keep more money in your pocket at the end of the day after the IRS is done with us. We're also going to be talking, obviously, about depreciation and how does that work in a syndication structure. The partnerships that we do called syndications, how does depreciation work in a syndication model? And then some of the strategies we do to take the benefits of depreciation and ramp them up and make them even more valuable and save you even more money. And then finally, we're going to talk about the expiring benefits, the urgent deadline that we're up against the clock here on December 31st. So, Mike, would you jump in? Tax strategy is essential. Tell us some thoughts on this.
Yeah, you guys, I think everybody has probably heard this quote before, that the most powerful force in the world is compounding interest, right? But right behind that is, well, how do you get income to start with for that compounding interest? And depreciation is a massive advantage that you can take advantage of in order to start that compounding interest. So, one of the things I like to ask people, and I'd love to see everybody put this in the chat real quick, but what are some of the largest, on average, expenses that Americans are going to spend their gross income on? I'm going to give you guys, 10 seconds here. Throw it up in the chat or even the Q&A section. What are top 3 biggest things that people are going to spend their gross income on? We got John with taxes. Yes. A lot of people say it's going to be, houses, cars, rent, groceries, whatever. One of the largest things, you're right, Cindy, John, you're all correct. It's one of the largest things that is overlooked is taxes, right? So if you can get a way that you don't have to spend that money towards the government, right? The government is an expense for you. If there's a way for you to be advantaged in that and save your money, well, then you can use that money to compound growth and make way more money down the line. And so the government allows you a few different ways to take advantage of that. And one of those ideas is depreciation. So, everyone's familiar with compounding interest, the concept, every dollar you invest gains interest, that interest gains interest infinitely, right? But hand in hand with that, and we're going to play another quick game here. Todd, your teenage daughter, that's hilarious.
That's my favorite.
Great answer. One of the other games that I like to play here is if you were to save, $10,000, let's say through taxes, and you invested it, and I'm going to use our Aloha Fund here as an example, because right now preferred returns on our Aloha Fund are 16%, right? If you took that 16% compounded return at 30 years, and I'm only going to give you 10 seconds because I'm sure somebody's there with a calculator, but what amount of money are you going to have at the end of that 30 years? Let's see if anybody has
no calculators.
A guess. Just take a guess. Take a guess.
Put your guesses in the chat box. Let's see who gets.
Let's see. If anyone's close, you get a cookie.
$1 million. That's right.
Not far off, Cindy.
Oh, yeah. we're giving hints now.
How much? Well, okay. I apologize, Cindy. I took that away from you then. But the answer is $850,000 about. And Cindy, yes, dang it.
858.
$850,000, right? A massive amount of money from $10,000 over 30 years, right? Now, here's the next question. What if you only invested for 25 years? Take a guess at that. Cindy, I'll let you throw in the first answer there. What's your guess?
So if you only 5 years less.
5 years less.
At the same rate, 5 years less, how much would it go down? Now remember, it was 858 before. So how much would it go down 5 years less?
Yeah, the answer is $400,000, guys, right? So over half of your returns are lost just by missing out on 5 years, right? So the concept is, and I'm sure many of you have heard it too, the best time to invest was yesterday. The next best is today, right? The perfect time to plant a tree was 20 years ago, if you get that concept. So, the power of that 5 years on compounding interest is massive. And so we're going to be talking about this more, but there are ways that the government allows you to take advantage of that, of massive tax gains up front through bonus depreciation. And we're going to get into that in a little bit, but I'll turn it over to JD for the rest of this slide.
Yeah, thanks, Mike. So the next section, that's really interesting, compounding interest. The next section goes back to what I was talking about earlier, where I said it's not just how much you make, but it's also how much you keep, how much of the money that you earn actually ends up in your pocket. So a typical long-term tax rate for long-term capital gains, typically 20%. It can be different. There are exceptions. It can be as low as 0%. It can be higher than 20%. But let's take the impact of 20%. So why do we obsess so much over taxes? Why is Mike crunching all of his spreadsheets to make sure that we can save as much as possible on taxes? Well, let's look at the impact of a 20% tax rate on the same numbers that we were looking at before. So $10,000, if you pay 20% tax, that's 12.8 is 20% less than 16%. $10,000 over 30 years. So before it was 858,000. Imagine going from 16% to 12.8%. How much does that bring your 858,000 down? It brings it down to $370,000. So from 858 to 370. And then again, 10,000 at 12.8 for 25 years is 203,000. Now I did that math in my head. I want you all to be very impressed. I was all right up here. I did the, no, I didn't. I'm not Mike. I can't do it in my head, but that's pretty shocking, right? Because that 20% difference compounded over years makes a huge difference in how much money you actually get to keep in your total returns. That's why when we're talking about comparing real estate investments, and so comparing a real estate fund like ours versus a savings account or versus a mutual fund or something like that, the benefits of these tax strategies, if they can make a 20% difference through the depreciation benefit, then it can compound your return over time. It can double it. It could triple it just by us reducing the capital gains that you actually realize by that 20%. So many investors are careful about expenses. So when we're going out and we're investing in real estate, we're analyzing investments, right? When we're buying a single family home, we're buying an Airbnb, we're very, very careful about maintenance. We're very careful about utilities. What's the property management company cost? But one mistake that many operators make, one mistake that many investors make, is they don't give enough attention on the front end to tax planning and the necessary attention that it takes in order to be successful. So we obsess over it. We're constantly looking down the pipeline, constantly anticipating and strategizing. We're going to show you some examples of that today. But the goal is, again, to keep the most money in your pocket that we possibly can. So this is one of the points of value that we provide, is that with real estate, it's sure the gross returns, the 16 to 18%, like we're talking about with the Aloha Fund, but it's also the net returns that you get because of the tax advantages that are provided within the fund itself. So Mike, I'll let you take the wheel. As soon as the spreadsheet comes up, I know it's my time to stop talking.
No worries. No, this is, yeah, just something quick to throw together to illustrate this point, So, again, using the Aloha Fund here as an example, right now, the Aloha Fund was started in 2022. And what happened was from 2017 to 2022, this was a law that was put on the books from the Trump era that allows you to take 100% bonus depreciation on two different types of asset classes, so personal property and land improvement. Now, basically, when you buy a building, multifamily, any kind of commercial kind of property, you're going to have a cost segregation study performed. And this is a study that's going to break down how and what is allowed to be depreciated based on the IRS's classification of assets. So there's really three big buckets. There's actually four. One of them is land, but of course, land is not depreciable, so I didn't include that here. But the three big buckets are personal property, land improvement, and real property. So out of those three buckets, typically 20 to 40% of that is going to fall in the personal property and land improvements section. And both of those buckets are eligible for bonus depreciation. So again, from 2017 to 2022, that bonus depreciation amount stood at 100%. So you could take the entire bucket that was lumped into those two categories immediately as of that year. So for example, in the Aloha Fund, we bought Orlando Sky here at the end of 2022, and our investors were able to benefit from $3.7 million of depreciation that was able to be taken in that year. Now, anything in the real property category is going to be straight lined over 27 and a half years. And so you'll get that residual continuing forward every year until the property is sold. Then what happens is every year after 2022, that bonus depreciation drops by 20%. So we are now in 2023 where we get 80% bonus depreciation. And we just bought a property in June called Arden Place. And so we did another cost segregation study. That bucket for personal property and land improvements came out to about 2.7 million, as you can see in the bottom half of that chart there. And of those two buckets, we were able to take 80% of that. And so any investment, for instance, into Aloha Fund up until December 31st, 2023 is going to get the benefit of that large depreciation offset. So this year's total for that fund is going to stand at 2.7 million. And so you can still take advantage of that up until the last day of this year. Now, after that, you still get the residuals from the real property side, plus a little bit of trail off on those two buckets for the remaining 20%, plus any kind of properties that we buy into 2024 that would stand at a slightly lower 60%. But yeah, that's basically the breakdown of how our Aloha Fund works with depreciation.
And so thank you, Mike. That was super helpful. We're going to dive into, if some of that went over your head, if some of those dots didn't connect, we like to be very upfront. So we like to show you the numbers first. This is what it looks like. This is how it breaks down. Now we're going to spend a little bit of time talking about what that means and what the significance of it is. So bonus depreciation. When Mike is talking about a cost segregation analysis, many of you know, but for those of you who don't, it's a segregation of a real estate asset into different components and the depreciation life cycle. So rather than the property depreciating over equal number of years, typically commercial real estate will be depreciated over 39 years. When it's got residential usage right here, that property can be depreciated over a shorter life cycle. So that increases the depreciation. That's one of the reasons we invest in multifamily real estate, is that it has that shorter depreciation life cycle. But if you look at the land improvement and you look at the personal property, those are depreciated over 15 years and 5 years. So those are shortened up even more. The bonus depreciation, these big numbers that we're talking about up here at the top where it says 100%, 80%, 60%, that comes from a law that was passed in 2017. That law made first year bonus depreciation a thing, right? And it was the Tax Cuts and Jobs Act, I think was the name of the law. And what it did is it said if the useful life of a certain component within the real estate is 20 years or less, then you can move that component, and there's always exceptions, there's always rules, but you can move that into the first year so that you take a big chunk of the depreciation in that first year. So when you buy real estate, you can move that depreciation up into that first year. Well, the law was designed back in 2017 when it was written. It was designed to sunset in 2022, 2023 progressively. And so at the end, December 31st of this year, it drops from 80% to 60%. So right now, if you invest before December 31st, we get the benefit, that first year benefit that we saw up here, that first year benefit in 2023, this 2.7 million number under 2023, we get that first year benefit in this year. If you don't invest this year, if you invest on January 1st or later, then your first year bonus depreciation has dropped by 20% on anything that you buy, period. But because we bought that property this year, and because we're only in the second year of the Orlando Sky, you get a lot of depreciation benefit, and all depreciation benefit flows through back to investors. And so that's why you've seen emails from us, you've seen communication. I know RADA has sent out some helpful information that if you invest before the end of the year, the clock is ticking, and there is a very real reason to try to get in before the end of the year. In 2027, that bonus depreciation drops to zero. So 20% every year. Right now it's at 80%. It's dropping to 60% on January 1st. Any questions or interjections, Mike?
We had one question come in from Salvatore. He was saying that if you had bought into Aloha in 2023, can you still get bonus depreciation from 2022? The answer is no. If your investment's hard cutoff point is that December 31st deadline. So any investment, for instance, made this year on December 31st versus January 1st of 2024 would have a completely different depreciation structure. So any investment this year will get Arden Place's bonus depreciation, and any investment in 2024 will no longer be eligible for that. So definitely better to invest sooner rather than later.
Absolutely. And that's why we say the clock is ticking. What you may have been thinking of was tax losses can be carried forward into future years in many cases. But when it comes to bonus depreciation, doesn't quite work the same way. Let me tell you, when I was a commercial real estate broker, at the end of the year, every single year, we got buried, we got slammed because people came to us and they wanted to try to invest in something. And so often people would pay too much for properties because their accountant told them, go out and buy something. And so people would kind of wait and say, well, I'm going to sell this, in December because maybe I'll get somebody that'll pay too much for it. They'll pay a higher price so that they can get that tax write-off before the end of the year. We're much the same way. We get very busy here at Multifamily Capital Partners towards the end of the year because folks are, they're hearing from their accountant, hey, you've got a tax liability situation. We need to deploy some capital so that we can save some money on taxes. To go through that due diligence process, that underwriting process, pick a property, make sure that the property is right for you, pay the right price for it. That's something we've already done, served up on a silver platter. Our acquisitions team was saying, Mike, I don't know if they've told you this, but our acquisitions team told me that they get sent 50 properties a day that they can review, 50 a day.
That's true. Yeah, most of the deals, the best deals are the ones you walk away from. So right. we have our opportunity for many properties. It's the ones that fit the perfect criteria are the only ones that we'll go after. So
that's right. We cherry pick the very best of the best. So unlike my clients that I used to have at the end of the year that would come in and say, give me something, and then they end up with a problem in future years because they didn't have enough time to do the due diligence, do the underwriting. We've done that for you. That process has been done. We've cherry picked the best of the best so that when you come in and you benefit from that tax depreciation, you get more money in your pocket over future years as well.
We had real quick, had a couple other questions. I know Doug said, is this only on commercial properties? So yeah, commercial properties have the ability to take advantage of this. every type of property has slightly different laws. For multifamily, for instance, on the real property depreciation side, it's 27.5 years. Some other properties are 39 years. So it's significantly longer on certain other commercial real estate properties. So you would have to determine what kind of property that is. But multifamily does get a quicker depreciation schedule.
That's right. That's right. And it can be different in your state as well, depending on how the land is valued relative to the property value within your particular state, and how that balances out over the life cycle. So, and the tax benefits of the Aloha Fund. So depreciation. So by the way, what is depreciation? Depreciation is a reflection of the useful life of an asset. That's kind of the technical definition. So the IRS is trying to say, okay, you bought this thing. Eventually, this thing is going to wear out. How do we recognize that in your taxes? Well, when it comes to real estate, the beauty of that is just like you can write off business expenses, just like you can write off costs, this is a cost. This is an expense, quote unquote, a paper loss, because you're not actually losing money. You're not actually spending money. I've heard people that'll go out and try to buy a truck right at the end of the year so that they can save money on taxes. Depreciation is a paper loss that allows you to save money on your taxes without actually costing money. So all depreciation that occurs within the Aloha Fund flows through to investors relative to their investor class, relative to their total investment, relative to where they fit within the fund and their percentage of the fund that they've invested in. Mortgage interest. I've been asked this a number of times. Is mortgage interest still depreciable when you're investing in a fund? Yes, it still flows through. At the end of the year, you get a K1. Keep in mind, guys, when you invest with the Aloha Fund, you are a partner with us. It's not like investing in a real estate investment trust. It's not like investing in a mutual fund. You are a partner. And so any benefit, the tax benefits, those flow through to you. You also get the benefit of the experience. You also get the benefit of the track record. You get the benefit of having regular webinars, regular communication with us and our investor relations team, so that you can establish a track record. And this is something that you want to go out and do on your own. It's going to make it a lot easier in the future to go out and invest in multifamily properties when you've got that track record that you've established with us. But that K1 that you get, that tax statement saying that you benefit from the depreciation, you benefit from the mortgage interest pass through, that is your legal statement. Look, I owned this real estate. I was a partner. Here's how it did. Here's how it went. The other thing with the Aloha Fund that you don't get when you're buying a single property is you get the capital gains offset. So if you've got capital gains that you're realizing from a property being sold, then the other properties and the depreciation that's occurring on those other properties can offset the capital gains on the one at disposition. Also, on the properties on the Aloha Fund, after you invest, 3/4 after your initial investment, you start to get quarterly distributions. So our preferred distributions are 8% annual. That's paid out quarterly. And those are taxed as passive income, a preferred tax rate relative to your active income. And it spreads out the gains. It spreads out the profitability of that asset, of that investment over a longer period of time, allowing you and your accountant to be more intentional in your tax strategy. And finally, long-term capital gains. So rather than, I flipped houses in a past life. You probably can't imagine me flipping houses, swinging a hammer these days. When I was a younger man, I flipped houses. But one of the difficult things when I was doing it is that you get the short-term capital gains tax rate, which is much higher. The long-term capital gains tax rate for holding over a year is much more preferred, much more advantageous tax rate, depending on your tax category. So all of these different tax benefits flow through to you as an Aloha partner. Any comments or questions, Mike?
Yeah, we had a couple questions. Josiah and Ronnie had similar questions. If you invested this year, when do we expect to receive the documents required for filing our taxes to take advantage of that depreciation? That's like what JD said with the K1s. So after the end of the year, we will work with our accountant and produce K1s that will be distributed to your investor portals. And you should typically see that around February, March timeframe.
That's right. And for those of you who don't know, K1, if you own an LLC, if you own an entity and you're a partner, then the income, the profit that you make from that entity, you get a K1. You're a partner with us, you get a K1. There's different tax forms for investing with passive investments like real estate investment trusts and mutual funds, passive income, passive interest. That K1 is documentation that you are invested right alongside us.
We had another quick question from Layla. She was saying, this means that in 2027, we are not going to be able to use depreciation as an expense to offset gains. No, not necessarily. It first of all depends on if they continue with this legal structure. I'm sure changes in administrations, they will, of course, change laws, as we've seen many times in the past. But even at the 2027 mark, all that would mean is that any bonus depreciation would not be applicable. So you would still get straight lined over 5, 15, and 27 and a half years. So any personal property would depreciate over 5 years instead of being able to take it all at once in that first year. So that's the power of bonus depreciation, kind of like I explained in the beginning, where, you know, if you're able to save an extra $10,000 in year one, well, you can invest that over the next 5 and make, considerable gains on that income rather than spacing that out over the next 27.
That's right. That's right. And then, Mike, wouldn't it be true that if additional acquisitions are made within the fund, that those potentially could get the bonus depreciation rate in that particular year?
Yeah, exactly. Lambert asked the minimum investment for the Aloha Fund, that's $100,000. And we have a lot of questions. Sorry, guys, just trying to get through all of them. But you get a K1 for all properties. If you invest in the fund, you'll get a K1 for the fund itself. So that will include all properties.
Mike, let me jump in, and I'll make a couple points about the Aloha Fund, and we can sort of take turns on this. So why invest in Multifamily Capital's Aloha Fund? The Aloha Fund is our flagship fund. You can partner with us we'll give you our contact information. Rad has already put the contact information in the chat. But you communicate with our team. You can partner with us before December 31st. There's still time, but just like I was saying, for commercial real estate brokers, we do get busy. And so I would encourage you to start the process soon so that we make sure that we've got your capital deployed before December 31st. But it's the ability to leverage our relationships. We got thousands of people in our network all across the country sending us deals every day that give us the ability to cherry pick the very best of the best of the best. We have the capital available to us. And so controlling over $400 million, that gives us the leverage to where Tyler and our executive team, we're classified as preferred lenders with Fannie Mae and Freddie Mac, meaning that we have access to lending tools, loans that if I went out and bought an apartment complex, if you went out and bought an apartment complex, we just wouldn't have access to those tools. And so there are benefits of the Aloha Fund that we can leverage and that you leverage by partnering with us that allow you to take advantage of those tools. We project that 100% of investor capital will be returned by year 3. So 100% of every dollar that you invest within the Aloha Fund, we project that will be returned by year 3, allowing you to recoup your investment. And then it's just about growth. And then it's just gravy. Go ahead, Mike.
We had a couple other questions. RP said, how much tax or depreciation benefit would one get from a 100K investment into the Aloha Fund this year? So we have Arden Place that closed this year, plus we have residuals from Orlando Sky that you would get. So for a 100K investment, there's, I think it was a roughly 40% from Arden as a paper loss, right? Now that is split between GP/LP 70-30. So you would get 70% of that basically on your paper loss that you can take advantage of.
Right. And again, with the disclaimer that there are a number of things that can adjust that to your benefit and to detract. For example, the tax category, passive versus active. Depending on how your accountant has you categorized, you're a real estate professional, not a real estate professional. Typically, active and passive can be in two different silos of income. And there are ways that those can offset each other, and there are ways in which they absolutely don't offset each other. So if you have additional questions, talk to your accountant, give us a call, and we can help sort of talk you through some of those things. But that's where we get the hedge against inflation. So in a future webinar coming up soon, we're going to be talking about inflation. Inflation, with interest rates where they are, we hear a lot about inflation. They're fighting inflation. Inflation's down, inflation's up. By buying appreciating assets that appreciate, while we can also get the tax benefit of depreciation, as inflation goes up, that's the time when demand for apartments tends to go up. As people take a step down, they decide, I don't want to buy a house. I'm going to rent an apartment for a little while, ride out the storm, so to speak. And so rents tend to do very well in what we call counter-cyclical assets. So as the cycle has a downturn, then rents tend to do well, cash flow tends to do well while we wait for the appreciation from a stronger market to occur. So you've got the cash flow coming in, the benefits of the cash flow in the down market, then you get the benefits of the capital appreciation in the up market.
It's actually a great question. Sorry to cut you off there, JD. I really wanted to touch on this too. I don't know who put this question in because it just says iPhone, but it says if since the Aloha Fund is a $30 million fund, and if I were to invest $300K at aka 1%, would I be receiving 1% of the depreciation or another amount? It's actually better than that because we take the depreciation value of the fund at the end of the year. So the Aloha Fund is indeed a $30 million fund. Right now, it's roughly half full, roughly 15 million or so. So we anticipate probably halfway through next year, we'll be finished and closed out with that. But you'll actually get, if you were to invest 300K, let's say, you would actually get the depreciation based on the 15 million. So you would actually double that amount because the fund has not fully been closed yet. So there is an incentive there to even be earlier.
That's a great point. Yeah, good question, iPhone. our phones really are listening to us. And they're asking good questions. But yeah, and thank you for sharing that, Mike. So yeah, the sooner really, would you say, Mike, that means that in the life of a fund like this one, investing earlier kind of gives you a little bit of an advantage, as the sooner the better, like you were talking about with the planting a tree analogy?
Hey, yeah, absolutely. I mean, one, you get the benefit of those accrued gains towards as the fund closes out in the future. Plus, you get all that bonus depreciation as of this year that future investors will unfortunately miss out on. So
that's right. That's right. Very good. Asset diversification up here on the top right. The multifamily capital partners Aloha Fund allows you to diversify your investments across multiple assets. So if you have investments in stocks, bonds, treasuries, whatever the case may be, what we like about multifamily is that it diversifies across tenants as well. So you got 200 tenants, you got 200 streams of income. So you've got a single family home, your tenant leaves, what's your occupancy rate? It's 0. You got a duplex, one tenant leaves, it's 50%. 200, it gives you some more diversification. But the benefit of the Aloha Fund is it gets even better than that because you're diversified across demographics and you're diversified geographically. So we've got assets at different places in the country, different regions, to reduce your risk so that, if there's a dip in an economy, if there's an event that occurs in one location, you've got the benefit of the other properties to offset that. So it's all about asset diversification. And by investing in one asset, the Aloha Fund, you get diversification across multiple geographies, multiple demographics, and multiple property types. Go ahead, Mike.
Yeah, now there's a ton of questions, so trying to power through them. We had another question about if we invest 100K into the Aloha Fund, how much cash flow will that generate quarterly? So it's 16% preferred returns at a minimum. So Basically, that is derived over a 6% distribution per year with a 10% accrual at time of sale. So, yeah, you can expect at least 6% per year is how that should work.
Yeah, and make sure that you follow up with us, because there are different investor levels in which you can invest. And so the return at the 100,000, like Mike accurately said, 6%. But at the 200,000 and the $1 million levels, then that preferred return becomes 8%. So that much more reason to jump in and invest with us. Did you want to take another question?
Yeah, sorry, Doug. I just wanted to hit on that real quick. He said if you invested 100K today, you get bonus depreciation, a pref of 15%, it's actually 16%, and others. We do have slides that can break that down for you, and that is true. Correct.
Yeah.
And then I know, Dennis, you were asking about depreciation recapture. I hard to answer you right now. If you want to reach out to us, I can get you a better answer, though.
Yeah, depreciation recapture. Yeah, later on when the funds are sold, we have strategies for reducing that as well. But yeah, it depends on your particular situation. Energy allocation. This is a big one that when it comes to investors, a lot of times we'll have people who will go to our multifamily mindset workshops or coaching or fast track or preview days, and they will believe in multifamily investing as an asset class. They'll believe in the strategy. They'll believe in what we talk about in terms of mindset. But they say, look, I got a business to run. I got a family. I've got other priorities. I just don't have time to go out and look for properties right now. I just don't have time to talk to a bunch of commercial real estate brokers right now. I just don't have time to try to raise capital from investors. That's the benefit of partnering with us. We do that for you. We operate for you, and then you participate in those returns. But at the same time, you're still getting that experience. You're still getting that track record. You're still getting the benefit of investing in multifamily real estate, so that what we want for every one of our partners, when you're able to step away from that business, when your income becomes more passive, at that point, if you decide, hey, I do want to go out and buy some more apartment complexes, you've already got the track record established when that time comes to be able to do that. And look, guys, we're experienced. We got a huge team. We've got the best in the business. We've got when we cherry pick properties, we cherry pick people. We got the best in the business doing the underwriting, doing the acquisitions, and crunching the numbers and making sure that we are picking the best properties and that we are strategizing for the maximum amount of profitability for our partners and for us, because we eat our own cooking. Our partners, Tyler, his money's invested right alongside you. We are not selling something, like brokers and things like that, where they don't have any personal interest. We're personally invested in a very real sense. We want the funds to do well because we're shoulder to shoulder with you for mutual shared success. Go ahead, Mike.
Yeah, Doug, just to answer your last question, it is good. I think you're probably thinking 4 to 7% return on distributions, which is in line with what we're doing. So we're doing 6% distribution, 10% on the back end for you at time of sale. So that's probably where that difference maybe lies for you, but that's pretty market standard. And then Rex said 6% net pre-tax. Yeah, you would of course pay taxes on any kind of, it's like a dividend payment for that 6%, right?
Right. Yeah, very good. And Rad, I want to mention, if you saw something that Mike and I missed, feel free to interject. But guys,
absolutely. So I do. If any of you guys that asked questions that we did not address, please use our link in the email section. I will post it again. Definitely reach out to us. We are here to serve you. So if your question was not answered by us and you need some further details, please reach out to us. Greatly appreciated.
Yeah. And I saw somebody asked about accreditation. We want to talk to all potential investors. If you're interested in investing with us, we'd love to get your information. We don't always have opportunities for unaccredited investors, but we often do, and we often have a waiting list when it comes. And so be sure to get in touch with us, and whether accredited or not accredited. We'd love to talk to you, get your contact information, and point you in the right direction for, you know, the investment that's appropriate for you. If you don't know what I'm talking about with accreditation, we could talk about that as well. But next steps, that's just it. Next step is to, and we'll take a couple more questions and then we'll hang it up in a few minutes. But this website, investwithmfcp.com, you can go on there, you can register. Rada has put some contact information into the chat. Make sure that you reach out to us. We would love to talk to you. We would love to communicate. We want to make sure that we get all your questions answered. As I said at the beginning, a lot of times we may not answer a question because it's so specific to your situation. Doesn't mean we don't want to answer it. We absolutely do. We want to talk to you. Please reach out to us. You can go to investwithmfcp.com. You can call the number on your screen. You'll get our investor relations department. Mike, thank you for answering all these questions. Is there anything else that you want to address?
Yeah, just the last thing is, the Aloha Fund is an accredited opportunity. We do get quite often unaccredited, non-accredited opportunities. So even if you don't fit that investor profile, we do have a pipeline of deals coming through that we could potentially get you in. So please, reach out to the IR team and we'll give you the deck as we get more information. So thanks, everybody. Appreciate the time.
Yeah, thanks for that clarification. Yeah, like Mike said, we would love to send you more information. We can email it to you. We can talk you through it. Different people learn different ways. We can give you more than you'd ever want to read. We can give you past webinars. Mike just recently did a fantastic webinar for our Aloha investors. We can send you the deck with all of the details. We would love to engage with you. We'd love to talk with you. So thank you for your time today. Thank you for spending a few minutes with us. We hope that this provided some value to you. As Rada said, please give us your feedback. Let us know what you'd like us to talk about in future webinars. We value your time. We take it very seriously. And we want shared success, shared growth for all of us. Thank you, Mike, for your time. Thank you, Rada, for your time. Thank you guys for partnering with us. And we look forward to connecting with you soon. Thank you. Bye, everybody.
Thanks, everyone.